Hey everyone! A major new tax bill has now become law, and for retirees, it could have a significant impact on retirement tax planning. If you're building a strategy for generating retirement income, taxes should be one of the most important pieces of the puzzle. There are plenty of provisions packed into this legislation, but the key takeaway right now is simple. There's a 4-year opportunity that could create some powerful tax planning advantages. Not every part of the law is permanent. While certain provisions will remain in place indefinitely, others, including the new senior bonus deduction and the higher SALT deduction limits, are only available from 2025 through 2028. That means the next 4 years may offer a unique chance to make strategic financial moves. In this video, we're breaking down exactly what this legislation means for retirees. We'll cover what's changing, what remains the same, and how you can take advantage of this limited planning window before it closes. Before we get started, be sure to grab my free guide. The one portfolio adjustment you need before retirement. Even investors who have accumulated substantial savings can face serious challenges if they enter retirement with the wrong investment approach. Inside the guide, you'll learn how to reduce sequence of returns risk, why the traditional 60-40 portfolio may not always deliver the results retirees expect, and how one straightforward adjustment can provide greater confidence in your retirement income strategy. You'll find the link in the description below. Now, this new tax law includes a wide range of changes, and it's impossible to cover everything in a single video. We could spend time discussing the expanded child tax credit, updates to charitable giving rules, the temporary deduction for auto loan interest, or the enhanced SALT deduction limits, which could be especially valuable for households in certain states. But today I want to focus on what I believe is the most impactful planning opportunity for the largest number of retirees: the larger standard deduction and the new bonus deduction available to taxpayers age 65 and older. This is where retirees can potentially create meaningful tax savings while these provisions remain available, and where the long-term planning benefits may be the greatest. Let's start with perhaps the biggest aspect of this legislation. The lower tax brackets and the larger standard deduction are now permanent. Until recently, many retirement plans assumed that the tax cuts enacted in 2017 would expire after 2025. If that had happened, tax rates would have increased across nearly every bracket. For example, the 12% bracket would have reverted to 15%, the 22% bracket would have climbed back to 25%, the 24% bracket would have increased to 28%, and so on. At the same time, the standard deduction would have been reduced, while personal exemptions would have returned. According to estimates from the Tax Foundation, the combined effect would have increased taxes for roughly 62% of Americans. This new law removes much of that uncertainty. The lower tax brackets remain in place permanently, and the higher standard deduction will continue moving upward with inflation adjustments over time. And that's worth pausing on for a moment, because many people overlook just how important the standard deduction really is. To understand why, let's quickly review how taxable income is calculated. You begin with your total income from all sources during the year. From there, you subtract above the line deductions such as contributions to a health savings account or a traditional IRA. What's left is your adjusted gross income, commonly called AGI. Next, you subtract either your itemized deductions or your standard deduction, whichever gives you the greater benefit. The result is your taxable income, which is the number used to determine how much federal income tax you owe. In other words, the standard deduction functions as a tax-free buffer. It's income that the IRS allows you to exclude automatically without needing to itemize deductions. That becomes even more important when we get to the new senior bonus deduction in a moment. One detail that hasn't received enough attention is that the standard deduction isn't simply remaining where it is today, it's actually getting larger. And I'm not referring to the new $6,000 senior deduction yet. We'll discuss that shortly. Beginning in 2025, the standard deduction increases by $1,500 for married couples filing jointly and by $750 for single filers. That brings the standard deduction to $31,500 for married couples filing jointly and $15,750 for single taxpayers. If you're age 65 or older, you can also claim an additional age-based deduction on top of those amounts. Married couples filing jointly receive an extra $600 deduction for each qualifying spouse, while single filers age 65 or older receive an additional $2,000 deduction. As a result, a married couple with both spouses over age 65 will have a total standard deduction of $34,700 in 2025. A single taxpayer over age 65 will have a standard deduction of $17,750. In practical terms, that means nearly $35,000 of income for many retired couples could be excluded from federal taxation before any additional deductions or credits are considered. For example, if a retired couple reports an AGI of $100,000, only a little over $65,000 would remain subject to federal income tax. And remember, that's before factoring in the separate senior bonus deduction we'll discuss next. I wanted to emphasize these changes first because the standard deduction increases alone are extremely valuable. Now let's move on to the new senior bonus deduction. Starting in 2025, taxpayers age 65 and older may qualify for a separate deduction worth $6,000 per person. For a married couple where both spouses qualify, that's potentially $12,000 in additional deductions. What makes this provision especially attractive is that it applies regardless of whether you itemize deductions. If you itemize, the deduction is added on top of your itemized deductions. If you take the standard deduction, which most retirees do, the bonus deduction stacks on top of that as well. For 2025, a married couple over age 65 could effectively receive total deductions of $46,700. That's made up of the $31,500 standard deduction, the $3,200 age-based increase, and the additional $12,000 senior bonus deduction. However, there are two important rules you need to understand. First, the deduction begins phasing out once income exceeds certain thresholds. The phase-out starts at $75,000 for single filers and $150,000 for married couples filing jointly. As income rises beyond those levels, the available deduction gradually decreases. Second, and perhaps most importantly, this provision is temporary. The senior bonus deduction is only available from tax years 2025 through 2028. That gives retirees a 4-year planning opportunity and potentially a very valuable one. This isn't something to simply be aware of. It's something to actively incorporate into your financial strategy. For many retirees, these years may provide a rare chance to reduce lifetime taxes through careful planning. Consider Roth conversions as an example. With the larger standard deduction and the temporary senior bonus deduction, you may be able to convert more money into a Roth account while remaining in a lower tax bracket, and in some situations, without generating any federal tax liability at all. Or maybe you've been holding highly appreciated investments inside a taxable brokerage account. This window could allow you to realize gains, reset your cost basis, and potentially pay very little tax thanks to these expanded deductions. And if you're coordinating withdrawals from traditional retirement accounts such as IRAs, this may be an ideal period to smooth out taxable income, reduce future tax surprises, and make required minimum distributions easier to manage later in retirement. There are countless planning opportunities that could emerge from these changes. But the main point is straightforward. Don't let these 4 years pass without evaluating your options. Once 2028 comes to an end, this opportunity disappears unless lawmakers extend it. Whether you're already retired or retirement is approaching, now is the time to revisit your tax strategy and determine how to make these temporary provisions work in your favor. Take action now. Speak with your financial advisor, run updated projections, and make sure your retirement plan is positioned to maximize the benefits available during this limited window. Thanks for watching, and I'll see you in the next video.